Welcome back. In this video, which continues chapter 6, we're going to talk about the role of banks and other financial intermediaries. We call them intermediaries because they are in the middle between borrowers and lenders, right? Savers, people who want to save money, like Marco in our last video, and people who want to borrow money, like Julia. So let's get started. So financial intermediaries are those companies, right, that match the people who want to save money and the people who want to borrow money. And so we'll talk about the roles of banks, especially where savers will deposit money into their checking and savings accounts, and borrowers, people who want to have a mortgage to buy a house or an auto loan to buy a car or a business loan to start a business or increase the size of their business, um, are able to come, and basically the bank then is sitting in the middle of that transaction. It makes that transaction easier. Now, in other financial markets, there are large borrowers, right? Especially large companies and governments who can sell directly or trade directly with investors. And so when we talk about bonds, a bond is just a type of a loan, and that allows companies and governments to borrow directly from investors. So they might want to have sell a $10 million worth of bonds, and they'll sell those directly to both large and smaller investors who want to buy those bonds. Companies, of course, also can sell shares, right? And shares are pieces of ownership in the company. They're also known as stocks and equities. And the initial public offering of shares is when a company goes from privately owned to publicly owned. And then once, of course, those bonds or shares are issued, then they can be traded in the bond market or stock market. And this is known as secondary trading. So you might issue a bunch of shares in an IPO, or issue a bunch of bonds, but then people don't have to hold on to them. They can sell them as they want. All right, so let's go back to Marco and Julia. And just remember, Julia is our borrower here, and Marco is our saver. But now we're going to introduce a new actor into the model, which is the bank. And so, again, we're going to have Marco, who has 100 units of grain, and Julia has no wealth. We're going to assume still that there's no money, there's no central bank, there's no government. But the bank is able to accept deposits and make loans. And so in this case, the bank has some grain in its storeroom. So think about this. We talked a little bit in the last video, that Marco could store the grain. And so think about the bank as the organization that says, hey, give us your grain and we will store it for you. Now, the interesting thing about the bank is that they don't actually store that much. They're going to have some in their storeroom, but mostly what they're going to do is they're going to take the grain from people who want to save it and give it to people who want to borrow it, and just have some sort of in reserve in their strong room, that's where, or vault, or whatever we want to call it. And so in this case, that would be the equity of the bank. Remember, equity is another name for net worth. It's just assets minus liabilities. All right. So we're going to have Marco. Marco can save 50 units of grain, right? He's going to go to the bank and say, hey, I'd like to deposit this grain in period one. And then Julia shows up at the bank and says, hey, I'd like to borrow 50 units of grain. And then that's going to allow Marco to save and Julia both to consume and to invest. And now this is our financial intermediation, right? And the whole purpose of the bank is to say, hey, I'm a bank. If you want to save, come to me. If you want to borrow, come to me. And now Marco and Julia don't even need to know each other, right? They don't need to find each other. And so the bank makes this transaction much more, makes it a lot easier. And of course, the bank will take some profit out of that. And so that means that generally Marco will receive less interest than he would in a direct loan, and Julia may have to pay more interest than she would in a private loan. All right. So let's think about the bank's balance sheet. So last time we looked at Marco and Julia's balance sheets, but the bank is also going to have a balance sheet. Now, when Marco makes his deposit, that's still Marco's grain, right? The bank says, hey, this is your grain. This 50 kilograms of grain, that is yours. You can come get it whenever you want. And so from the bank's perspective, right, that's a liability. From Marco's perspective, it's an asset. Remember, every asset is a liability and every liability is an asset, sort of. Um, and so in this case, the liabilities for the bank are the 50 kilograms of grain that Marco has deposited. Now, when Julia shows up and says, I would like to borrow 50 kilograms of grain, now that is an asset for the bank, right? It's a liability for Julia. Julia owes the bank that 50 kilograms of grain, but for the bank, that's an asset. Now, we assume that the bank started with 10 kilograms of grain in its strong room, and so it still has that, right? That's an asset. And so its total assets then are 50 plus 10, or 60, and its total liabilities are just 50. And so the net worth, or equity, or also known as capital, is just 60 minus 50, or 10. All right, so let's think about what would happen if Marco is depositing 50 units of grain and getting a 6% interest rate, and Julia is borrowing 50 units of grain and paying a 10% interest rate. So Marco has 100 kilograms of grain to start in period 1. He consumes 50, right, and deposits 50 into the bank. Julia borrows that 50, and so she consumes 20 and invests 30. And so far, right, this is just the same as the example we had in the last video. Now, Julia plants that 30 kilograms of grain and grows it, works hard, and is able to harvest 90 kilograms of grain. Now, she still has to pay back those 55 units, right? She borrowed 50 at a 10% interest rate. 50 plus 10% is 55. And so she is still able to consume 35, 90 minus 55. Marco now is getting 53 because he's now getting a 6% interest, right? He's not getting that full 10%. And the other 4%, those extra 2 kilograms of grain, are going as the profit to the bank. And so the bank has done something useful, right? That's why it gets a profit. It has matched that borrower and that seller who might not even have known each other, might never have been able to find each other, or certainly not easily, and has made that transaction possible. And that's why the bank gets a profit. Now, notice that the important thing for the bank, from the bank's perspective, is the spread between the interest rates, right? So it receives a 10% interest rate from Julia, and it pays Marco a 6% interest rate. So that 10 minus 6, or 4%, is called the interest rate spread, and that is the bank's profit, right? Now, in the real world, of course, banks earn profit from lots of different things, but certainly still one of the important things is the difference between the interest rate it receives from the borrowers and it pays to its depositors. All right. So if we think about bank profits, right, then the revenue from lending is just the interest rate on the loans times the total lending. The payments to depositors, so the cost that it has, is the interest rate on deposits times the total deposits. So in this case, the revenue was 10% times 50, or 5. The costs were 6% times 50, or 3. And then the profit was just 5 minus 3, or 2. And so basically what this means is that spread, right, that interest rate spread, and then the amount of total lending are the key drivers for banks' profits. Now, we have to think about risk, right? Because whenever you are lending to anybody, the problem is that they might not pay you back. And so the risk then is taken on by the lender when it's the case that they're just a bilateral debt contract, like in the last video. But from a bank's perspective, they have to worry about that as well, right? Because if Julia takes that 50 and doesn't pay it back, then the bank doesn't have enough to pay Marco back his 53 in the next period. And so the way a bank does that, obviously, one is that they have lots of borrowers and lots of depositors. And so they are able to, make sure that, if one borrower doesn't pay them back, then they'll be okay. But then they'll also have to charge different interest rates, right? And so, for riskier borrowers, they'll charge a higher interest rate, and for less risky borrowers, they'll charge a lower interest rate. Now, one way that a borrow is less risky is when they're borrowing to buy an asset like a house or a car, because then if they don't pay them back, then the bank takes that asset. So if we think about, we talked about, the rate of return, right? The total amount that the borrower actually pays back minus the loan divided by the loan. That's like the interest rate, but it's taking into account the fact that there is some risk, that there are some borrowers that won't pay back. And the bank is able to spread the risk out, right? And so they'll have lots of borrowers, lots of depositors, and therefore, if one of them doesn't pay back, they'll still be able to earn a profit and pay back the depositors. So this is really important. And of course, you want to make sure that your bank is not taking on too much risk, because if your bank takes on too much risk or takes on a lot of risk that is correlated, if that's related to the risk of other borrowers, then there's the potential that they won't get paid back enough and they won't be able to pay their depositors. And so that's really the risk of banking and financial intermediation at all, is that if enough of the people who are borrowing the money don't pay back, then the banks can't pay back all the depositors and people lose money and you end up with a very bad economic situation. So most of us don't think about that these days, and we'll talk about sort of why that is. But in the old days, sort of before the 1930s, you did really have to think about bank risk, because there were banks that would fail and people would lose their savings that they had put into a bank. And so from a bank's perspective, you wanted to convince, your depositors that you were controlling this risk. And so one way to do that is to diversify lending, right? So to lend in lots of different types of areas, lots of different types of people, so that, you're not taking on too much risk from one person or one area. The other way is to say, listen, I'm going to hold on to more of your deposits in order to, have that cushion, right? And so remember from our example, the bank had that 10 kilograms worth of grain. We called that its equity or its capital. We could make that a larger amount, right? We could say, no, a bank, you need to keep not 10% of your assets, but 20% of your assets as, capital, so that you'll be able to pay back your depositors if more of your loans go bad. And so this is sort of the lessons that we learned about banking in the 17th and 18th and 19th centuries was, all right, well, banks need to have enough capital, but they also probably need to be regulated. And so because there's this incentive, right? There's this incentive to make lots of loans, because that's how you increase your profits. And also potentially to make riskier loans, because riskier loans pay a higher interest rate, right? And that interest rate spread is also important to your profits. And the problem, of course, right, is that if your assets and your liabilities are very close and your assets fall by a little bit, then you owe more money than you have, and you're going to go bankrupt. You're not going to be able to continue to operate. And so This is one problem with a bank. The another problem that's related is what's known as liquidity risk. And the idea with liquidity risk isn't that your assets are worth less than your liabilities, but that your depositors or the people from whom you're borrowing money are all going to want their deposits at the same time, right? So usually if you think about a bank, you have people depositing money, you have people taking out money. And most of the time that you kind of know how much people are going to want. But if people take a lot of money out, then the only way to pay them all back, right? If once you run out of your sort of liquid reserves, your liquid cash, is to start selling your assets. And that's a problem of liquidity. It doesn't mean that their assets were worth less than their liabilities, but their assets are sort of long term, right? They are mortgage loans and car loans and government bonds and corporate bonds. And if they're not able to sell those easily, then they might not be able to pay back all of their depositors. And when depositors get nervous that they're not all going to be paid back, that is what leads to what we call a bank run. And so with a bank run, basically what happens is everybody who has given money to the bank as a deposit starts to get worried about getting their money back, right? Maybe they hear from someone that the bank is in trouble, or maybe they're just driving by and they see a long line out of the bank. Or maybe, in a modern example, they see, online that there's that somebody says this bank is going to go bankrupt. Well, what do? Well, you want to try to take your money out as quickly as possible, right? Because a bank that's in trouble that either has, even if it's just a liquidity problem, but especially if it's made too many bad loans and the assets are worth less than liabilities, is not going to be able to pay back all of their depositors. Now, the good news is that for most commercial banks now, for commercial banks in the United States, deposits are insured up to a certain amount. It's $250,000 currently. And that means that if your bank goes bankrupt, the FDIC, the Federal Depository Insurance Corporation, will generally close the bank on a Friday, find a bank to either buy it or merge with it, and make sure all of the deposits, at least up to $250,000, will be available usually when it opens on Monday. This was not always the case, right? So this was definitely not the case in the early parts of the Great Depression, where we had huge numbers of bank runs, and people lost much of their savings in these bank runs. We'll talk about that towards the end of the semester when we look at the Great Depression in more detail. All right, so we'll stop there and we will continue with Chapter 6, now looking at sort of the role of money, right, which we haven't even really talked about yet, even though we know banks really deal with money. They don't deal with grain. And then the role of the central bank in the banking system.